Welcome to the Stranded Technologies podcast. I'm your host and founder of Infinita Fund, Niklas. In this show, we talk about how to accelerate the future. Our thesis is that many life-improving technologies are held back by institutional barriers. How can we unblock vast opportunities while mitigating against the risks? What ethical principles, rules, and regulations can guide us on that path? We will discuss these questions with entrepreneurs, policymakers, and industry experts. If you enjoy the show, please give us 5 stars and visit us at infinitafund.com to join the community.
Today is June the 9th in 2022, and my guests are Sean Pawley and Rasheed Griffith. Sean is the founder and CEO of Seshat Bank, an API-first, full-service commercial bank for Latin America. Sean, welcome to the show.
Thank you for having me, Niklas. It's good to see you again.
Same. Rasheed is the COO and Chief Compliance Officer of Merkle Hedge, a company specialized in market making and asset trading software. Rasheed, welcome to the show.
Hi, thank you for having me.
So I invited Sean and Rasheed to the show to discuss the intersection of innovation and regulation in fintech, particularly in banking and in crypto. Sean and Rasheed have deep expertise as entrepreneurs, and they have to navigate a complex web of national and international regulations. In this conversation, I want to tease out lessons for entrepreneurs and innovators on how to navigate this complexity in the financial sector. If you want to meet the three of us in person, join us for the Prospera FinTech Summit on August 26 to 28 on the beautiful Caribbean island of Roatan in the country of Honduras. Go to infinitafunds.com to sign up. All right, let's jump into it. Sean, let's start with you. Please tell us about your background and how you come to found Seshat Bank.
Sure. So I started work on Seshat Bank a few years ago after experiencing just a lot of frustration with East African banks and terrible customer service, terrible experience. And I started thinking about what a bank I would actually want to work with would look like and what that kind of experience would be. And my thoughts there really formed the nucleus of what eventually became Seshat Bank. So the key points there were the bank had to be API first, so it had to be very, very developer friendly. People had to be able to build applications directly on top of the bank itself. It had to be something where you could easily do this. And all of your banking functions could be automatable and programmed. It had to be user friendly. So there needed to be very, very, very easy, user flows. And we needed to have a very design centric approach very, very early on in the process. And then there were a few other things as well, such as Uganda and East Africa as a whole was fairly low trust, region. And so there were some other things that I built in there, such as our escrow product to, essentially allow people to engage in commerce without actually needing to trust each other. And, you know, those sorts of things formed the core of what eventually became Seshat Bank. Now, I moved it from East Africa over to here in Prospera. Actually now it's a little bit over a year ago, due to a considerably better legal environment here in Honduras. Basically, here we would be operating under American KYC AML law, which is generally just a much better degree of enforcement, and it's much safer, and it's a regulatory regime that our correspondents are very, very familiar with. It gave us a lot of flexibility with regards to our risk management regulations and how we can actually interact with depositors and with borrowers as well. So we made the switch over here, and we've just been plowing ahead, and we're about ready to launch. So very, very, very happy with the work that has been done so far.
Fantastic. So customers that are in Honduras and in what other places can use your banking services?
Well, as long as you're not on an OFAC sanctions list, you can work with us. So, you know, we're not really geographic centric. As long as you meet our compliance standards, we're happy to work with you.
Fantastic. And what's the suite of products that you're offering right now? I know you announced a new product the past week.
Yep. So right now we have a savings product that we've recently announced for high net worths and for companies. Basically, just help them better manage their individual and company treasuries and earn a little bit of interest on the side. And alongside that, we're also starting to lend as well to a variety of commercial entities.
Fantastic. We'll get back to you on that. But Rasheed, over to you. Please tell us more about your background and how you come to found Merkle Hedge.
I started working in a cryptocurrency-centric company in Barbados back in 2015, around that time. And from there, what I was in charge of is essentially compliance and regulatory affairs. I had to speak with regulators across the Caribbean and across Central America. And that, gave a lot of perspective on how regulatory interests think about new emerging markets and new emerging technologies and products. From there, I did a similar job in Southeast Asia, again, interfacing with regulators, primarily working in compliance, building compliance departments in those areas to deal with fintech, and specifically fintech that has an interaction with cryptocurrencies. After that, I did a bunch of consulting for some law firms in New York and had clients across the world in Southeast Asia, East Asia, Eastern Europe, Central America, and so on. I think around, after 2 years more of doing that, I joined forces with some colleagues and friends, and we co-founded a company that essentially takes advantage of the opportunities that we've been seeing in the markets, primarily cryptocurrency markets, when it comes to spreads. Essentially, we make money on spreads. And in doing that, we design our own algorithmic trading systems, and we deploy capital on global cryptocurrency markets. About this time, we have 4 offices in 4 countries: Canada, Panama, Barbados, and Philippines. And we essentially do 24/7 high-frequency cryptocurrency trading.
Fantastic. And what services do you offer to your clients, and what clients would you like to attract to Merkle Hedge?
I should say we're not very client-centric. It's primarily proprietary trading. It's a hedge fund attachment. So we have, for example, very few clients who are commercial products. For example, we have clients that are cryptocurrency exchanges. We have clients that are hedge funds in themselves in their different markets. And we work with them to essentially design a strategy that primarily focuses on cryptocurrencies. Over time, we're going to expand that to a larger client base. But for now, it's pretty much proprietary trading.
Fantastic. Rasheed, you're based in Panama. Panama is known as a special jurisdiction for finance. Can you give us a background to Panama as to why it's popular for financial companies?
Panama designed its regulatory frameworks maybe 2 decades now to harness this urge of financial companies to have much more stable and transparent regulatory outlooks in their operations. Essentially, Panama was that kind of cluster. However, that has decreased quite substantially over the last few years, over the last several years in particular. Post, for example, various scandals and corruption problems that the international world perceives to be the case in Panama. That has had a very large
Panama Papers, right?
Panama Papers, that's right. And, that's some other things as well. And I think essentially that has caused a really big issue in Panama when it comes to financial service industry. However, it's still substantially large. Don't get me wrong, it's still quite big. And it still has very good, for example, tax treatment, very good, for example, clarity when it comes to the regulations like AML, KYC, liquidity, all those kind of things. And recently they've passed, the Congress has passed a law in Panama to essentially go into this, what we call a cryptocurrency ecosystem. I say Congress has passed it because the president has not fully signed it as yet. But over time, before the end of the year, Panama will have a very all-encompassing cryptocurrency-centric regulatory system. That's going pretty exciting for some people.
Fantastic. Sean, back to you. How do you start a new bank? Can you give entrepreneurs who listen to this episode, give a little step-by-step guide?
Well, the first step is you hire a bunch of lawyers. Any time that you're starting a bank in any jurisdiction, there is a pretty substantial amount of compliance work that you just have to do up front just to interact with essentially the rest of the financial ecosystem. Finance is a very, very, very heavily regulated space, and you need to be aware of that up front, and you need to be willing to pay a fairly substantial sum for legal advice and for compliance work before you are ever operational. So that's step one. Step two is just do whatever your lawyers say. There's a process to acquiring a bank license in every jurisdiction on the planet. Follow the process, you get the license, and at the end, you're able to take deposits, issue loans, and do all of the other things. Now, there are some ways around that. For instance, so in the United States, it's very, very, very difficult to get a proper banking license. So a lot of companies, neobanks, have started up that are essentially piggybacking off an actual bank's license. Now, what this piggybacking does not allow the neobank to take assets or to take deposits or make loans or do anything of that nature. Instead, the neobank is essentially a pass-through entity. So it acts basically as a UI/UX improvement for the proper bank, and it makes basically all of its money off of interchange fees and a small portion it's effectively just marketing fees, but basically it's an interest payment from the bank to the neobank based on the amount of deposits that the neobank has attracted to it. So that's a fairly popular way in the United States and in Europe to interact with the broader public. I don't think it's a particularly good way of going about it. It's a lower cost way, but it's pretty bad unit economics for a business like that. But yeah, as far as starting a bank goes, step number one is just hire a bunch of lawyers. That's it. We're in a very, very heavily regulated space, no matter what jurisdiction you're operating out of.
So, the neobank being piggybacking on existing institutions, is that mostly in the United States, or does it also apply to the big neobanks in Latin America, like Nubank or N26 in Germany or Revolut?
No, so it applies to, I believe Revolut actually has a proper banking license now, and I think N26 does as well. But they all started off in the neobank model where an existing bank sponsored them, and they were able to get basically all of their money off by interchange fees and off of some paltry interest fee that the bank actually gave them. But it's fairly popular in the United States and Europe. You can see it elsewhere as well. There are a few here in Latin America. So for instance, Nubank actually started off that way, although Nubank has since gotten banking licenses in Colombia and Brazil. So now they're a proper bank. And you can see it over in some Asian countries as well. And in Africa too. So it's pretty well accepted model internationally. Usually what it is basically companies or founders will pursue this model basically as a way to demonstrate that there is actually traction for their idea. It really only makes sense for consumer banking, not for anything commercially oriented. But for consumer banking, it's a way of essentially demonstrating that there is in fact demand for the kind of services that your bank would offer. And it allows you to relatively inexpensively test that before pursuing a proper banking license. And so that's a fairly popular way of doing that. There are some companies that retain the neobank model, such as Cash App in the United States, even when they're large enough to get a proper banking license on their own. But it It varies considerably. In general, though,
But-
they do pursue bank licenses and means.
But they start this way particularly because the fixed costs are so high to get a banking license, to the time it takes until you get it, and compliance costs, right?
Yeah. So from a compliance, so basically just from a starting up a bank point of view, so in most jurisdictions, you're looking at $10 million plus in basically equity that you can't touch. So this is money that's just going to be held in reserve to protect against losses on loans. So you have $10 million plus in capital requirements. In many jurisdictions, it's substantially higher than that. So in Honduras, under the ordinary regime, it's about $20 million now. If you're looking over in Rwanda, it was $7 million up until very recently. They just bumped it up to 20. If you're looking in Colombia, it's $9 million. So, considerable variation, but that's still a substantial amount of money that basically you're asking investors to invest that you're not actually going to use, and you're not actually going to be doing anything with. Secondly, just the cost of developing the software for banking, very, very expensive. You're looking at probably close to $2 million in software development costs, minimum, and very, very likely to be more than that. And then there are all of the costs associated with card issuance. And if you're looking to receive cards as well, or act as a card acquirer, there are a whole host of additional costs associated with that. So everything adds up very, very, very quickly. It's a pretty capital intensive project to get it started up.
Mm-hmm. So that makes it very hard, especially for startups to start new banks, right? But you have, you're going a different way. Can you tell us a bit why you've incorporated in Prospera and how you can use that to your advantage?
So within Prospera, we still have to meet certain capital requirements, and we still have certain regulatory standards that we need to meet. And it's not like software standards, or it's not like the software development cost goes away just because we're here. That development cost is the same no matter where you are on the planet. But we chose Prospera mainly because it's just a considerably better legal environment. So we have much, much better clarity from the government of Prospera with regards to how the risk management laws are going to be enforced, how basically auditing is going to be conducted, how KYC AML laws are going to be enforced, how, in general, it's just much, much greater clarity from the government and much higher quality as far as regulatory enforcement goes. It also is much, much, much better than the ordinary regime, just as far as basically, I'll call it asset seizure. So in the event of default, if we lend someone money to purchase a house or something like that, it can take a fairly considerable time to go through the ordinary court system. In Prospera, we can go through arbitration and get a judgment fairly quickly, and pursue and foreclose on any properties that have defaulted very, very quickly.
Fantastic. Rasheed, from your experience in the Caribbean, how is the environment, the regulatory environment in other parts of the Caribbean? Because I know there's many special jurisdictions, including Panama and Barbados, where you worked. Is there any location there that's especially interesting or conducive to set up a new bank?
A new bank? I mean, the Caribbean is not very known for its banking industry in any real way. A lot of offshore centers in the Caribbean focus on, for example, hedge funds, insurance, mutual funds, trust, those kind of services. Of course, there are some offshore banking in the Caribbean, but it's not very high end. It's not very good, actually. So most of the times, the true utility for a company, let's say, for example, a company in Panama, a bank in Panama, they might have a subsidiary in the Caribbean, but that is mostly used for balance sheet optimization. So, for example, they will, given that some offshore Caribbean centers might have a less stringent requirement on non-performing loan portfolios, they will essentially outsource some of their non-performing loans to a Caribbean jurisdiction that's technically a bank subsidiary, but the bank in the Caribbean that already have that much customers and so on and so on. So in terms of those kind of like operational bank capacity optimizations, Caribbean is very good for that. Whereas the operating banking, it has never tried really to be very good at that.
So we've already touched on a number of international financial regulations, and these are important to understand for any young entrepreneur. Sean has already mentioned, you need to start with lawyers, start a new bank, right? So it's very important to understand some of these regulations. So I'd like you, please give our listeners a quick walkthrough. What are AML-KYC laws? Rasheed, we can start with you, and Sean, you can add to it.
So AML-KYC laws have two very broad components. One is an international component, and one is a domestic component. So every country on earth, an incredible country on earth, has very sophisticated AML-KYC, CFT, and know what we call...
To break up these synonyms, AML means anti-money laundering, KYC know your customer.
Correct. There's also CFT, which is counter to financial terrorism. There's also counter proliferation financing, which is essentially anti-nuclear arms financing. So that's a very new one as well. And most countries, all credible countries, have to have legal frameworks to essentially prevent those things to happen. And their international bodies is fairly new in the world. The Financial Action Task Force is primarily a European body. Only really got teeth in post 9/11. The U.S. Bank Secrecy Act, for example, got really improved by the Patriot Act, which is also post 9/11. And also in the EU, they essentially upgraded their AML rules, called AML directives, post 2004. And those ones have been essentially pushing the globe in a much more complex, what they call compliant culture for financial services. And in doing so, the idea is that, okay, well, you need to primarily collect a lot more information about your customers to prevent the idea of money laundering. This is actually mostly just theoretical, because the rules, for example, in AML, CFT, KYC, and counter proliferation financing rules are actually just mostly bureaucratic concept. So, for example, Barbados does not have any material money laundering happening in the jurisdiction, but you would think so, because Barbados is considered a quote high risk jurisdiction by the Financial Action Task Force. But if you ask yourself, people tend to not actually ask the question, why exactly does FATF consider Barbados to be a high risk jurisdiction? It's not because of any proof of material lapse in AML rules. Because if, for example, you ask now, well, there's this war, in Ukraine and Russia, and people say, okay, you got to sanction a lot of Russian money, for example. That money is not in Barbados, for example. That's money in London, it's in New York, it's in Miami, so on and so on. So the reason why, for example, Barbados is on the high-risk jurisdiction list for FATF is because, in part, one of the main ways that Barbados does the analysis for AML, essentially real anti-money laundering, is through something called the Capital Controls Act. Essentially, Barbados has a capital controls rule where if you need to get money out of Barbados, you have to go through the central bank and their limits and so on. You got to ask for clearance, so on and so on. So a lot of the analysis is say, hey, you're trying to get money out. Where is it? This and that. But however, for the FATF, they do not consider the Capital Control Act a credible way of doing AML. They prefer that to be the Proceeds of Crime Act. So when you read, for example, the review of FATF to Barbados, they will say, hey, you guys need to improve your Proceeds of Crime Act and not rely upon the Exchange Act to do AML. Therefore, you're high risk. It's actually a thing that's said. So very oftentimes, when you think of concepts of AML and CFT, all these other initialisms, you got to remember that a lot of time is primarily bureaucratic discussions, but the material problem of AML CFT is actually not that complicated. And that's one of the weird things that I think people don't know about AML CFT. A lot of it is bureaucratic compliance, which is, unfortunately, you still have to do it because that is a rule, but it's not as complicated, I think, as people assume it is. But yet, people still don't want to do it.
So there's the bureaucratic concept of AML-KYC, right? And then there's the material. What do financial institutions actually do against money laundering, right? And there's kind of like, what you do to be AML-KYC compliant is not necessarily what you do materially to prevent anti-money laundering. Is that correct?
That's correct. Yes.
Mm-hmm. Which kind of makes it ineffective in a way, right?
Yeah, I mean, AML, let's call it general compliance rules, are extremely wasteful. It is notoriously wasteful, actually. And it has the secondary and tertiary effects that compound the wastefulness if you do an opportunity cost calculation. So it's one of those things where, you don't really want to do it. And you can make a very credible argument why you should not be doing it in this way that the regulations ask for. But the problem is that in the game theoretic situation we are all in, we have to play the game.
Fascinating. Sean, you mentioned before there's a very high fixed cost for software development for banks. Do AML-KYC compliance, does that play a role when it comes to software building? Can you kind of quantify how much of the cost that is for new entrepreneurs that think of starting something?
So it's a decent portion of it, but most of the cost for KYC AML comes in. So you're going to pay a decent amount for KYC upfront just because you need to purchase. As far as KYC software goes, the pricing for that is pretty much always sold in blocks. So you'll probably be spending $70,000 to $100,000 just to purchase and license that software. The transaction monitoring, though, is where it gets a lot more complicated. Now, the software itself is you're going to pay a decent amount for that, but the costs for that are not necessarily front loaded. You're just going to need to pay for quite a few more compliance personnel, or you're just going to need to pay for quite a few compliance personnel to dig through transaction records and analyze individual transactions to determine whether or not they meet, bank standards for what would actually qualify as a suspicious transaction and trigger an SAR.
That's kind of fascinating to me. What Rasheed, what you said, sort of this mismatch between, the regulatory requirements and the material effectiveness. Would you go so far in saying that complying with AML-KYC makes actual fighting money laundering harder in some cases, or is that unrelated?
I don't think it makes it harder. I guess it depends on what harder means, right? Because there are situations where you might be bogged down with specific regulatory requirements, so you can't really look into what could cause harm in your company. So I know an example. This is doing consulting. Clients who have to comply with rules, they have to have staff that do all the particular monitoring and so on. But no one was really done to do the proper audits of the compliance system. They weren't really thinking down to actually sift through really credible information. And they actually missed quite a lot of, let's just say, suspicious transactions. And that happens, but unfortunately, you can't not do the typical jurisdictional and international compliance. So you kind of have to double up again on the compliance departments. That's why over time, data in the US is a lot more transparent. Banks have been tripling AML departments in the last 3 years. It's gotten that bad. Essentially the administrative bloat of AML has itself like changed the way how banking is done in especially large jurisdictions. So it's quite severe actually. People can really underestimate how severe AML compliance rules have become.
That's fascinating to me because it's a story that frequently occurs with many regulation. Probably at some point, the laws have probably very good intentions. And at some point, they might have also made a lot of sense, right? But, the world is complex and changing, right? So the regulation that you made at some point are not necessarily reflecting what you need to do to sort of fight what you're trying to fight.
I'll give you an example of some regulatory creep that is very insidious in some ways. So we eventually term money laundering quite a lot, but implicit in term money laundering is that what the term money means. So what is definition of money in money laundering? People assume that, deposits and cash and coins and, transfers and wires and all that stuff, which is an intuitively correct understanding. But actually recently, the last 3 years, FATF has changed the definition of money in money laundering. So typically it was just M0, that's the cash and coins and deposits, and it went up to just include like treasuries and those kind of things. But now it's all the way to M3, where it's like including things like long-term securities fraud and all those kind of things. And for small countries in particular that do not have any especially active capital markets, they still have to comply with all these long-term capital market compliance rules, even though they don't have very active markets. So that actually makes the cost of complying even higher and causes even more friction in those economies. And that's a very recent development. And you can think that could also creep into other asset classes as well as now considered to be money. So even those kind of concepts are stable and those increase in time. And so administrative bloat.
Let's move on from AML-KYC. Sean, can you explain what is the Foreign Corrupt Practices Act and how does it affect international finance?
Well, it doesn't really impact finance too much, I would say. It impacts investment in poor countries, but I'll get into that later. So the FCPA itself, the Foreign Corrupt Practices Act, essentially prohibits any American businesses or persons subject to an American company, so any employees or agents of an American company, from giving bribes to foreign government officials. And the objective there is to hold U.S. companies and U.S. persons to a very, very high standard.
That sounds good.
And to minimize corruption globally. Companies can be held liable for any bribes that occur, even if they were not aware of it, even if they were not aware of them occurring. But the end result of that has been that there's been a notable decrease in investment in quite a few poor countries that tend to be fairly corrupt. But what it really means is that essentially, if you are going to be investing in and putting money into a lot of these countries, you are typically going to be better off working in a special jurisdiction within those countries that has either relaxed or different rules than the national regime, simply to minimize your risk of exposure to the FCPA. You don't necessarily control your employees on the ground all the time, and you certainly do not want someone to bribe a foreign government official on your behalf, even without your knowledge. So you're typically better off just investing and staying in the special jurisdictions where the risk of any kind of FCPA violation is minimized.
That is fascinating. Sean, we worked in East Africa, so you have a lot of on-the-ground experience. So you're saying it's kind of very, that seems like a good idea, but it's in practice very hard to comply when you can be held liable for what, what employees do or what your subcontractors do, things like that, right?
Well, it's pretty easy if you're a small company because then, you're the one in control. So if you're a small country or a small company and you ultimately, control the company pocketbook, it's very, very easy to comply because all that needs to happen is, if the police pull over one of your trucks that's delivering goods and they demand a bribe to let your truck pass, you refuse. And, that's it. There if anyone demands a bribe, you refuse and then you're compliant. It becomes a lot more complicated for larger companies. So Fortune 500 companies, it's fairly complicated for them. And for most of them, they'll actually, purchase, fairly sophisticated, FCPA compliance software just to ensure that, none of the money that they have goes to a politically exposed person. And they really try to minimize the risk of that, to the greatest extent possible.
Now that sounds good in some ways. In other ways, it makes it very hard to build a bigger company or go to a country when you are a bigger company, right? Because, you again have a very high fixed cost for compliance. And there's potentially also so many things that are just seem too risky for you for doing that you just probably deter a lot of companies from being more active in many poorer countries, right? Which would also benefit those countries, right?
It does. And, there are quite a few larger companies that simply don't have any operations, in the global south due almost entirely to the FCPA. There are quite a few that do as well. Mining companies, oil companies, for instance, they don't decide where the minerals are in the ground. They don't decide where the oil is in the ground. They need to go where it is regardless, the environment within those countries. But they typically have extremely, extremely large, legal departments dedicated just to, controlling that kind of behavior.
Fascinating. It's again, one of these unintended consequences, right? I'm sure the regulators who drafted that were thinking of what they said, like minimizing, corruption. And the unintended consequence is that you reduce investments for countries.
I mean, it all came about after Lockheed Martin bribed, a Dutch prince back in the 1970s. There was a massive, massive scandal, and that really, was what brought about the whole law.
But the problem with SCAP is that even since the Government Accountability Office, it's a very big office in the US that people don't actually pay attention to. They write its reports that you would think are almost like heresy when you read them, but they write reports essentially reviewing the different regulations of the federal government. And I think even back in the 90s or actually could be even the 80s, they did a review of the FCPA, so it's not too long after it was passed. And they said, businesses, I think it was like 1.5 of the businesses they're surveyed, US companies, large companies, say that they lost business because of FCPA. And we knew these numbers for a while now, but the problem is that a lot of regulation has a stickiness that even though everyone in the industry can say, oh, this is a terrible regulation, I mean, it's still there.
Yeah, it's a very good point. The stickiness, right? I mean, it's not, when you're a business and you have a department that doesn't work well, right? So you can get rid of the department, but with a regulation, once, it has unintended consequences and it leads to, things that you didn't want, you can't just easily just scrap it, right? That happens very rarely.
Yeah. Well, I also say that this is the constant push and pull between regulators, most regulators and industry, where there's different interests that are trying to be optimized. So regulators optimize for essentially performance art. They have to show people that they're doing something for very superficial ideas that the people think are bad or are good, very bland concepts. So they are not optimized for efficiency in say profitability in companies. That's not their game they're playing. Where companies gotta play a different game, at least with profit motives and stakeholder growth and so on. So you're all going to have this kind of regulatory push and pull, and especially in sophisticated markets where industry is quite large and the regulatory system are also quite large. So the FCP is one of thousands of examples of this very boring analysis.
Yeah, exactly. By the way, since you correctly said, Rasheed, we probably all agree on sort of the scrutiny that regulators could get for some of these laws. If you're a regulator or a policymaker and listening, you feel free to be invited on the show to debate our points here, right? Because, with all discussions about sort of how can we unlock innovations, right? And we're talking often about how regulations are, not innovation friendly. It's also very important to mitigate against risks, right? So I'm inviting you up on the show if you want to debate those points with us.
I mean, I would also double down what I said, where I oftentimes it's not that regulators do not understand unintended consequences. It's that that's not the thing they have to care about. So in most systems, regulators are not there to regulate. They're there as essentially political appointees from politicians. That's usually how it is. So the system doesn't really enable them to be very good for industry. I mean, in financial regulations, you can see it's very, very plainly. So they might actually agree with what we are saying, but that doesn't mean too much.
Yeah. Well, on the other hand, many regulators are quite aware that they can have a profitable career in industry after they're regulators, right? So the counter argument would be very often they are actually working towards the industry, towards the interests of many companies, right?
Yeah, in many ways, that's true. In many ways, many individual people do that. But very oftentimes the system isn't in its parts.
Now, of course, that's our interpretation, right? That I agree with. But, many people who go into regulation, go into policy making, go into government would say they do it for noble purposes, right? To actually sort of fight anti-money laundering, to fight money laundering and things like that, right? But let's just leave that there. I'd like to move over to another interesting piece of regulation. Rasheed, can you tell us a bit more about securities laws? I'm particularly interested because, the title of the show is Stranded Technologies. And I learned recently about securities laws, right? So this is a new field for me. What I learned is that securities laws came about in the New Deal era to regulate stock market exchange, right? The security basically means, it's an asset that you can trade, you can buy and sell it, right? Back then they were thinking about stocks. And there's a limit on, and securities need to be registered with the SEC to be tradable, right? Correct me or edit me if I'm saying anything wrong. Now, what's interesting now in the debates around cryptocurrencies or tokenized assets is that regulators often invoke these securities laws, right? So they're saying, a coin or sort of a tokenized asset, say, for example, you're tokenizing real estate into multiple pieces and buying it and selling it, or NFTs are in fact securities. And as such, they need to be registered with the SEC.
Mm-hmm. So I guess I correct one part first. Securities, equities form a very small subset of securities. There are many broader things that also count as securities. So in terms of cryptocurrencies, the aspect of securities law that people think of is called investment contracts, which is essentially something you buy to get a profit from. That's a very, very bland version of it, but essentially that's what it is. Now, this has been very clear to be a security for case law is, very strong on this since the 1940s, actually. And I think in most cases, when you look at the facts and circumstances of a lot of cryptocurrency offerings, tokens, ICOs, any kind of frame you want to put that in, yeah, they do fall under this investment contract definition. That's been, very much clear, very much there for anyone who works in finance for, many, many decades now. So I don't really think it's too controversial, really speaking. The problem is that people will say, so what? That's the problem. They say, okay, well, maybe it is security there. Why should we want to comply anyway? So that's a different part. The question, if it is security, in most cases, not all, yeah, you can make the argument that it is security, called an investment contract. But then the question is, should it be security? Well, that's a very different question.
Yeah, that's exactly my point, right? I mean, securities laws are, almost 100 years old. And now we're facing kind of new innovation on sort of the alternative money side in crypto and Web3 and NFTs. But it's kind of what I mean by a stranded technology. Some of these regulations are holding back some of that innovation, right? Because when you're doing, for example, a tokenized real estate marketplace, like my wife is going to set up, you living under that threat that regulators say, probably correctly, that these are securities. And if they are securities, you need to register them with the SEC or they're regulated, which would put you under the purview of facing actually, again, very high compliance and regulatory costs, right? So that would deter a lot of investors. And that again, sort of undermines innovations that I think could benefit a lot of people, right? I mean, why not democratize access to finance more? Why not let people invest in startups, which is also for other reasons hard because of the accredited investor rules. So yeah, I think regulators should ask themselves the question, or we should ask the question, why do we have these regulations in the first place? Why?
Well, I think you got to be careful with this one, because regulators don't make laws; they enforce and refine laws. Mm-hmm. So you have to say, why shouldn't U.S. Congress repeal the law? That's the question you have to ask, because regulators cannot do that, right? So the Securities Act of 34, 33 were passed by Congress. So to actually have a drastic revision of those, it would have to be a congressional type thing or a very high Supreme Court type thing, which the Supreme Court does not do that kind of drastic policy changes. So that would have to be a congressional change. And as you might know, the U.S. Passing these kind of fundamental laws is not a thing the U.S. does anymore for various other reasons. So I think you got to be careful. It's actually not a regulator that's causing the problem in this case, because they're just enforcing the law as it is, which is Congress.
Thanks. That's a very, very important clarification, Rasheed. Thanks for not letting me get away with telling something very imprecise.
I agree in some ways that the regulations, the law itself is it doesn't help expanding essentially the class of investors in a very real way. And that could cause the lack of capital formation in many strong ways. At the same time, so I guess on one level, anyone can understand why the law was passed to protect people from, essentially losing all their money. The problem is, if you're going to talk about consistency in laws, I mean, you can, for example, go buy a gun and kill 10 kids, but you can't put your money in a startup. So when you think about consistency of many kind of things, it doesn't actually work out. So I think that a better alternative, many lawyers and economists have essentially made this point, which is like you should just have a requirement to have very clear disclaimers, something called a dumb disclaimer, where it's like, if you want to invest in this thing, you got to sign something and say, hey, this is actually very high risk. It could actually either be dumb and you could use all your money at one time. Sign here, please. Well, you can't claim you don't know the risks at that level. So I think simpler things like that kind of simplification, for example, is a much better way to go about the capital formation aspect, which I think would be more the product you have in securities law, where the formation part is too difficult. However, you still need to have the protection part, where it is that, well, if, for example, this company becomes a big company, so it's on the public market, it has to have security. You have to have security that everything actually is managed properly. And that aspect of securities law, I think, is quite fine, because you don't want to come and just say, okay, well, we actually spent all the money. We don't really gotta tell you anything. So boom, we're done. That's bad. That kind of thing. So it's a prudential regulation of securities markets. Then you can say the regulation is actually pretty good. In terms of the capital formation aspect, yes, I can see the friction. I do think that should be changed, but that's a congressional problem.
Fantastic. And I also agree that, there can be, it needs to be prudential regulation, right? It's just the way political incentives are created we're often more likely to get bad regulation and good regulation, but I'm all pro good regulation.
Mm-hmm.
Sean, do you have anything to add when it comes to securities laws?
Well, I agree with Rasheed on those points. In general, I would say have stricter enforcement of fraud laws and get rid of most of these securities laws. But basically, if you're raising money for something, and like Rasheed said, you go out and you spend it all on completely unrelated things, that sounds a whole lot like fraud to me. Or if you mislead your investors or, anything of that nature. Stricter fraud enforcement and broader fraud enforcement would seem better than securities laws. And at least as far as democratizing investment and making sure that people have access to a lot of the high growth companies that are out there.
Great. So let's get to another piece of regulation that are very important in international finance context. Sean, can you talk about risk management regulations?
Sure. So, this applies a lot more to me than to Rasheed anyhow. But risk management regulations themselves just apply to banks, and it really covers what you can and cannot do with deposits, how much risk you can take, what kinds of risk you can take, and things of that nature. So in most of the wealthy countries around the planet subscribe to an agreement called the Basel Accords, and there have been multiple versions of these that have gone out since the financial crisis. And these laws basically cover the amount of equities that banks are required to hold in reserve, what banks are allowed to do, how assets are going to be risk weighted. Covers a number of different things, basically. But banks in those countries need to follow these sets of rules. The general idea is that if you require banks to be better capitalized and take lower risks, then the chance of essentially a catastrophic bank failure, like happened in 2008, is substantially lower. Now, when you're getting into less developed countries, it doesn't necessarily make sense to hold the banks there to those kinds of standards, simply because you're trying to encourage economic growth, and the business standards themselves require banks to hold substantially more equity and long-term capital in reserve than you may necessarily want to in a developing economy. But they kind of follow things that are similar to the Basel system. Central banks will have the five different asset categorizations and assign various risk weightings to them. Banks will need to have a certain amount of capital right in reserve. Banks will need to have a certain amount of cash on hand to meet their current withdrawal needs, et cetera, et cetera. And so that's the basic way that bank risk management works around the planet. It's simply handled either by the central bank or by a bank supervisor. It can be one or both. It depends on the country. And yeah, that's very, very broad strokes how the risk management side of things works. Now, for us, we operate under a slightly different system here in Prospera. So we operate under the Pawnbroker for all seasons model, proposed by Mervyn King in his book, The End of Alchemy. So the Pawnbroker for all seasons model really just, it changes a few things, but basically, the kind of risk weighted assets, all of that, the Basel system, it goes away under this regime. Instead, what happens is banks and other regulated entities are required to open up their book to the central bank or another credible third party lender. And this central bank is able to see all of the assets that these banks have on hand, and is able to assess haircuts against these individual assets. And the banks are required to maintain at any point in time, essentially an amount of capital or an amount of equity or long-term capital on hand equivalent to assets less whatever haircut the central bank assesses. This in general will require banks to be more conservative with their current liabilities, but they're able to be much more creative with their long-term capital. And the idea is it also
Can you
gives central
explain
banks-
that? Can you explain that again? That they're more conservative with their current liabilities, but are taking more risk when it comes to other assets.
Yeah, sure. So you'll notice that with that formula, assets less haircut, it needs to be greater than the bank's current liabilities. And the reason for that is that when you're talking about deposits themselves, central bankers are primarily concerned about, I'll call it, they're concerned about current depositors. If grandma has her money in the bank, no one wants grandma to lose all of her money because the bank went under. And so it's all about concerning retail depositors and people who have current accounts with these banks. It's also about ensuring that the bank itself actually survives long enough for, I'll call it, if the bank is in fact insolvent, it's about ensuring that the bank survives long enough where assets can actually be spun off and, longer term liabilities the bank can come to some kind of an arrangement with its creditors. But it also gives the central bank more insight into how the banks are actually capitalized and what kind of arrangements the bank has with other banks, what kind of counterparty risk it's exposed to, and it gives central banks and regulators a much more transparent look into the overall ecosystem.
So what's the, can you talk a bit more about the problem with that model? Like you also in other times call it the lender of last resort model.
I mean, so that it's related to it's somewhat related to the topic that we were just discussing. But the lender of last resort model just says that the bank is going on. A bank has short-term liquidity needs. The central bank can step in and provide some financing so that this bank can, meet its short-term withdrawal needs. And there's not going to be a run on the bank. So it's just there to provide short-term financing in the event of emergencies. And essentially every central bank around the world fulfills this function. It's short-term liquidity is very, very important for banks, but ultimately central banks. So in the event of a crisis like what happened in 2008, the central bank doesn't actually know which banks are in fact solvent and which banks are, insolvent. Every bank is going through a liquidity crunch all at the same time. But for some of them, it's just a temporary crisis. For others, this is indicative of a far deeper problem. The central bank doesn't really know which is which. So it gives a lot more transparency to the central banks so that they actually know which is which, and they're able to, effectively go in and they can intervene, they can save the current depositors. But, counterparties who engage with that bank are still, on the hook for whatever when this bank goes under. And it's essentially greater transparency to regulators. That's one of the big benefits.
So correct me if I'm wrong, but that sounds to me like bank bailouts, just more targeted, right? That's the change compared to 2008.
Not really. Basically the lender of last resort model would actually be a bank bailout because the central bank doesn't know which banks are insolvent and which banks are solvent. So the central bank would be bailing out banks that are not, in fact, good businesses. With the Pawnbroker for all seasons model, the central bank knows which ones are solvent and which ones are not. And the central bank will simply be essentially providing enough capital so that all of the current depositors can withdraw their funds or, they can switch to another bank or this bank can be sold to another one.
Yeah. No, sorry, I was confused between sort of what you're proposing, the Pawnbroker for all seasons model and the lender of last resort model. It seemed to me that's a weakness of the lender of last resort model, right? That you don't have that transparency in the banks.
Yeah, so the lack of transparency can certainly contribute to issues. And I don't know, it can lead to bailouts. It doesn't necessarily have to. The central bank may just decide to take a loss on any loans that are made to bad banks. or it can choose to bail them out and, make them solvent again by lending them even more money. But that's ultimately going to be a question for the central bank itself. The Pawnbroker for all seasons model essentially obviates a lot of the risks associated with that model.
Yeah,
and it makes the whole system more transparent.
Yeah, just to ponder a bit on that point, even at the risk of you repeating yourself, because I think it's a very important point. But why does Mervyn King say that the current system, how central banks operate, and sort of the regulations they put banks under, and what they do in case of financial emergency, is basically bound to repeat the mistakes of the past when it comes to the financial crisis? What's sort of his diagnosis, and how does the Pawnbroker for all seasons model potentially overcome this weakness?
Well, his main objection to the current system is just that there's not enough information to actually address a lot of the uncertainty that's in place in banking. Banking is never really a game of certainty; it's always a game of odds. And essentially, from his point of view, from back when he was governor of the Bank of England, the central bank just doesn't have enough transparency in these banks, the kind of counterparty risk that they're exposed to, what their books actually look like, to make these loans effectively in the event of a crisis. And so by switching over to Pawnbroker for all seasons model, you actually minimize the risk to current depositors. You give the central bank a lot more, substantially more clarity as far as what bank operations actually look like. And you just make the whole system much, much safer.
Got it. So all these questions are really, really important and have wide-ranging impact, right? So, and that's something that you're trying to change with your bank too, right? So do you see the potential for broader adoption of that model and sort of the more open banking API first model that you're innovating?
I think that the API first aspect is something that's going to be implemented by a lot of banks globally. I don't know if Mervyn King's proposed regulatory framework is going to be adopted more broadly. Prospera is the first jurisdiction globally to have adopted it, and I don't know of others that are considering it at the moment. So I can't really comment or say that anyone else is going to copy it, but at least as far as the API first banking goes, I think that's going to be a fairly popular model globally in the long run.
Right. What do you see? What things other than regulation do you see as a challenge when it comes to innovation in the financial space?
When it comes to innovations in the financial space, I tend to think that once something is legal, the innovations happen pretty quickly. Or once it's legal or technically possible, innovations tend to happen very, very, very quickly in the financial space. A lot of the innovations within finance I'll say they have more to do with legal changes than a lot of other things. So when you're talking about banking law in particular, quite a few of the historic innovations within payments and within lending models and within how deals themselves are structured came about due to the legal regimes that were operating in the various European principalities up until the early 1800s. Feels like once the 1800s rolls around, feels like a lot of things kind of standardized across the globe, at least with regard to financial laws, or at least the broad principles of financial laws. But before that, there was a pretty significant amount of variation. So you had things like the Medici Bank and a lot of the early banks made their monies entirely off of bills of exchange, which was a workaround due to the prohibitions on usury in capital Europe at the time. You see, the Fugger. Jacob Fugger, he was probably the first modern banker in the 1500s. He was the personal banker of the Habsburgs. He tended to not actually lend at interest. What he instead would do would be he would lend you would give money to the Habsburgs in exchange for all of the revenues generated by a silver mine or some other asset that the crown itself held. And the loan itself would be tied to the revenues generated by that specific asset. There's, the whole Dutch East India Company and joint stock formation and all of those things as well. But a lot of the innovation within the financial sector tends to follow these old forms and not precede them. And there are some other things as well recently, just with regards to disintermediated payments within the crypto space that are new, and those do precede legal changes, which is unique. But we'll see. They haven't been too broadly adopted yet, and we'll see how far that particular stream goes.
Yeah, and also crypto was kind of like same as digital and the internet, like that came without any significant regulation addressing kind of what it is or what it does, right? Instead of regulations in a way lagging behind, to giving, entrepreneurs enough time to create new things, right?
Well, I also, I don't know, there's the crypto space itself. I tend to think that it has been dramatically overhyped as far as how much innovation and how much new things it has actually generated. But yeah, it's at the time that it was created, it was largely unregulated, or in the event that there were regulations, they were not enforced, and that has given it a bit of a way to turn into what it is today.
Rasheed, would you agree with Sean that crypto is hyped?
I guess hyped by who? I would agree in the sense that most of the activity in crypto, when it comes to finance related things, is quite lame. And it's lame because you're trying to just catch up with what already exists in financial markets. The technology, the infrastructure, the instruments, those things just reinventing what's already, not reinventing, but essentially coming to terms with what's already existing in the world. I tend to think most of crypto is quite boring, but it's not a very bad thing, right? We trade crypto, but not because it's, some new things from Mars, is because there's opportunity to make money from it. That's how we see it. I mean, we don't consider ourselves a crypto company. I think people kind of misunderstand what it means to be a crypto company. A lot of times it just sounds good to say you're a crypto company, but you actually don't do anything on the technology side. So I think most of there hasn't been much innovation in crypto when it comes to financial stuff. I actually don't think the biggest breakthroughs that are crypto-centric will be financial related either. And no reason it should be. Now, in terms of also general financial innovation, I think most of it has, slowed down quite substantially. There are lots of things that we could be doing, even say should be doing in financial innovation that we don't. And I think all this big interest now in crypto payments and payments in general is, it's very, very boring. And it's actually very inconsequential to capital formation. So a lot of things that actually help capital formation should be the goal of actual financial innovation isn't discussed that heatedly, I'd say, in technology circles as yet. There are very sophisticated players, of course, that discuss these things very concretely. But most of the discussion is, just noise. And that will be the case for quite some time, I think. But you really haven't seen much financial innovation. Really in the last 20 years.
What are the kind of financial innovations we're thinking of that aren't talked about enough?
So there, I guess there are two kinds. One is essentially monetary innovation, one then financial innovation, where I don't really think it's the same thing. So in some ways, for example, the difference between essentially interest rates in emerging markets and interest rates in developed markets are quite widespread. the way to intermediate that is not a very trivial problem, and it is a technology problem. We haven't really figured out exactly how to do that as yet either. That's a fairly simple issue. The ideas of having, I think people kind of underestimate, for example, the magic of a 30-year mortgage. Like, if you were to break down what that means to have a 30-year mortgage stability over time, it's quite fascinating that we humans have been able to engineer such an instrument. But those kind of instruments over time are actually quite innocent. Things, for example, like actually having liquid prediction markets is a financial problem. It's a financial industry called a financial engineering problem. And prediction markets can actually impact quite good for especially poor countries. Even, for example, things like having, it's a guy called Robert Shiller, a Nobel economics laureate, had this idea of what we call macro markets, essentially market the macro variables. Suppose you have, for example, a derivative contract on the GDP projections for Barbados. That will actually help Barbados stabilize different growth rates over time and have different liquidity sources that will reduce borrowing rates for capital, liquidity, and bonds. Those things don't exist yet either. So there's so much financialization that's yet to happen, that should happen for the benefit of capital growth across the world that isn't there yet. And things like payments is honestly quite lame.
Mm-hmm. John, do you have anything to add on innovations that are not enough talked about?
I mean, I completely agree with him on that. As far as other things, well, he mentioned 30-year mortgages. I wouldn't really consider them to be a positive innovation. There's a whole lot of very, very negative side effects that come with that, and it involves a whole lot of government distortion of the market that I don't think is particularly desirable. But no, with the broad strokes, I tend to agree with him. I also tend to disagree with this point that the divergence in interest rates between developed and developing markets is a technology problem. I think it's first and foremost a legal problem. And it has to do with essentially just the cost of recouping assets and just the nature of the legal environment in those countries. I think that's really the primary driving figure. There's some other things as well. So, for instance, countries that have very high birth rates are just by nature of that fact going to have substantially higher interest rates due to the fact that a lot of expenses associated with people are front-loaded. Education, roads, power consumption, all of those things people incur before they actually start generating income. And so you should expect developed countries with high birth rates to have much, much higher interest rates just based on that, even in the event of comparable legal environments. I think just improving the quality of regulation, improving the ease of contract enforcement, improving the ease of asset recovery. I think that all of those things would reduce interest rates in the developing world a pretty fair amount.
So I don't disagree that it would reduce. I'm not saying that interest rates are the problem to reduce per se. I'm saying that the capital allocation of low interest rate environments to a high interest rate environment is something that should be taken advantage of. And that in itself is not easily done right now. And yes, there is a legal jurisdiction problem, for example, but that is not something that will be engineered away anytime in the near future. However, there can be also technological solutions to perform capital allocations across borders that will actually not be that much hampered by these regulatory problems. For example, like I should be able to, for example, I do work in Cambodia. I know the history of Cambodia quite well. I should be able to do this come good. It should be a platform essentially. I say a platform to put it glib, but it's also more complicated than that. To transfer money from the US to Cambodia to take advantage of this spread. But that's not something that's very easily done right now. And yes, I understand the cross-jurisdictional problems, but I'm suggesting, that there could be a technological solution to that. And in many other comparable situations, they have been. That's just marked by a very thin point. The other issues of why it's there is the different problem.
Yeah, I mean, I completely agree with you on all of those points. No disagreement from me on those.
Fantastic. Are these financial innovations that you have in mind, are they going to happen in the innovation capital of the world, in Silicon Valley or in California?
I don't
John?
know that California is the innovation capital of the world anymore. That ecosystem certainly has the best, the most capital to actually innovate in these areas. And it certainly has the most resources to actually do things in these areas. Whether or not they will actually do things in that area, in these areas, is a whole another question. But they certainly have the means and the resources to actually do something there. Whereas I don't really think the rest of the world does.
Like California seems to be imposing more and more regulations. It's getting more and more expensive. Housing is becoming unaffordable, and people are increasingly moving out of California to Texas or Florida.
So they are doing that. I don't know that that will necessarily impact a lot of the changes that we were talking about. It's so the point that myself and Rasheed were more discussing with this speech. California itself and Silicon Valley more broadly has the resources and the means to go after this, whereas no other place really seems to have at this point. The question right now is whether or not people that actually are there have the inclination to pursue some of these opportunities. And I don't know that they necessarily do. California and Silicon Valley as a whole is fairly provincial. I don't know that they would really go in for a lot of the things that we've been discussing so far.
Yes, I agree with that point. I think that there's a talent problem. I think primarily is the issue really. Yes, there's a capital constraint, but there's a talent problem in the sense that, there's this, you can phrase it as the most brilliant minds of our generation are slinging ads as PowerPoints at Goldman Sachs on Facebook. Right? That's their job. But if they would be doing other things, you would have a lot better innovation system in the world, because they have the talent and they have access to the capital. But there's this issue where the talent is kind of trapped into these large institutions, essentially doing grunt work. And unless we can somehow break that mold, which I am not very optimistic on in the short term, a lot of these far-reaching issues are going to persist. Even now, you're seeing that people are leaving, Google is so boring now. I got to go do some startup. But there's still so much talent trapped into these large institutions that causes perhaps supply shock when it comes to solving big problems. That's a very pronounced problem.
Would you agree about the trapped talent problem, and what's holding talent back from starting their own things, moving to other places more? Like there's a lot of talk recently about sort of complacency in the United States and sort of lower rates of labor mobility, lower birth rates, and sort of generally a lower amount of startups being founded or new companies being founded.
I don't necessarily know that the golden handcuffs are the reason, or I don't necessarily know that the golden handcuffs are really holding back innovation rates. Mostly because I'm not sure that a lot of the people who are held back by golden handcuffs are the kinds of people who have the mentality to go out and start something really, really big. But they need to work in the places though, because you could have a very brilliant founder that has good vision and so, but he needs a good team. And there actually is a shortage of technical talent globally, well, especially in the US in particular. And if this talent is just, kind of, if we have very good financial engineers, just find they're just happy doing PowerPoint slides at Goldman Sachs, or good AI scientists doing ad generation for Facebook. You're going to get a team to be able to fund your very good innovation, even though you are a very good founder. Mm-hmm. Yeah, that is true.
Great. So, what do you hope that we can achieve through locations such as Prospera? How can we overcome sort of the barriers to innovation?
I think that the Prospera platform itself has done a very good job of addressing a lot of little challenges. If you have a product that you think should be legal, and as long as you're not violating the various codes that apply, you should be able to produce it and sell it within Prospera. And you should be able to determine whether or not it would actually make sense and whether or not there would be a market for it.
Generally speaking, I think you just need a space where the people in charge say, let's do stuff. I mean, it's me raise that simple, because that inculcates this culture of growth and progress. I get to work. And sometimes people kind of underestimate how important that is.
I couldn't agree more with you. I think this is also a great way to end the conversation. Let's build. Sean and Rasheed, it's been a really great pleasure talking to you. I think you've given our listeners very, very important insights into how they can get started and navigate the complex landscape of regulations to bring innovations to market. And also you've given us a lot of great ideas on what to think about when it comes to making real change in international finance and what tools we can use to make that work. So thank you, Sean. Thank you, Rasheed.